About 2 minutes past the top of the hour. I say we go ahead and get started. Taylor, how are you doing this fine afternoon?
Doing great, doing great. Thank you for having me, and look forward to hopefully covering some new material here for most, and can get complicated pretty quickly. So we'll try to keep it relatively light.
We're going to keep it high level, we promise. I'm Jake Alexander from Action Accounting. The name of today's event is How to Position Your Business for Sale. We really appreciate you taking some time out of your day to join us here live, or if you are hearing this after the fact on the recorded copy as well, we still appreciate you. Thank you so much. We're going to talk about how to position your business for sale. I have with me today Taylor Yoner. I'm Jake Alexander, per usual, and we're excited. I've got a handful of questions myself here that I selfishly want to ask you, Taylor, and I'm sure other people that are tuning in have questions, and I know you're going to cover some great stuff. What I like to do just to keep us on track, we always make an agenda for these just out of respect of everyone's time. Our goal is obviously to bring as much value to everyone here as possible. And in respect of your time, keep everything on track. So what we'll always do here, cover a little housekeeping first. What I'd like to cover is just kind of the structure and the format for today's event. If you're joining us, you probably noticed this is a little different from a typical Zoom meeting where like everybody's faces up and everybody can talk. If you've ever been on a Zoom meeting, a regular Zoom meeting with more than 4 or 5 people trying to talk at the same time, you realize it can instantly go off the rails pretty quick. So in respect of everyone's time, we don't want that to happen. This is the webinar version of Zoom. So we still want to interact with you. We still want you to ask all your questions. The way you'll do that is there's a little chat box down at the bottom, and then there's also a Q&A box as well. So if you have questions throughout the event, we would encourage you to interact and to engage as much as possible. The way you'll do that, though, is either with the chat box down there at the bottom or with the Q&A box. You might have to click the More button to bring the Q&A box up. You can use that, or you can use the chat there. And so I encourage everyone to ask as many questions as possible while we have Taylor here. We're going to do some quick intros. At the end of the day, this presentation isn't about me, or it's not about Taylor. It's about the actual content. But I always think it's nice that we're not perfect strangers up here talking to everybody. So just some quick intros on us, on a little bit about our background. And from there, we're going to go into the meat of what we're going to talk about today. And Taylor, I'm excited to hear about this stuff here. So we're going to talk about a business sale, how to position your business for sale. So what to know, what to ask, and more importantly, like how to prepare for it. And then, of course, as usual, we got plenty of time for Q&A at the end. Typically, well, we schedule these events for an hour. Typically, the presentation portion is 25 or 30 minutes, depending on how much stuff you actually got for us today, Taylor. But we do that specifically to build plenty of time in at the end for Q&A. And so we want to hear those questions. If they come up during the actual presentation, like I was saying, pop them down in the chat or in the Q&A box. We'll make sure one way or another we get to those either live when you ask them, or worst case scenario by the end of the event. So ask as many questions as possible too. Quick introduction on me, and then I'll turn it over to Taylor. Most of you know me already, but if not, just to make sure, I'm Jake Alexander. Action Accounting is the name of our business. We got 4 main departments in our company. We do bookkeeping, which is really just the beginning of a financial infrastructure for business owners. We're categorizing transactions to help create financial statements so business owners can use those to make informed decisions. The financial statements are really important, like the P&L and the balance sheet, for understanding how much money's coming into the business, how much money's going out of the business. Then if one day you do plan to sell the business, those financials are going to be of the utmost importance, right, Taylor?
Absolutely.
Then we have tax preparation department. They're responsible for filing business tax returns for the business themselves and the individual owners of those businesses. We can help out with that, making sure everything is filed timely and compliant for you. I jokingly say, but not really jokingly, in pretty much all seriousness, where the real magic happens is in our tax planning department. That's where we're proactively working with high net worth individuals and business owners doing multiple 6 figures plus per year in profit to put proactive strategies in place to legally and morally get them to pay the least amount of taxes as possible. And so then last but certainly not least, our newest department is our business consulting department. And we're pretty excited about this. This is new department for us, which we are strategically growing pretty slowly for taking on new clients. But this is where we help clients turn their business into an actual business. So it's heavily focused on systems and processes and really putting a strategy in place to optimize your business long term, where hopefully one day we can work with somebody like Taylor and his team to sell it for the most profit possible and achieve all of those goals that you ever wanted. So if you ever need anything from us and our team, you can always find us at our website, which is actionaccountingusa.com. We would always encourage you to follow us on all the big social media channels as well. And so that's just a little bit about me. I'm going to turn it over to Taylor here in a second. And Taylor, if you want to introduce yourself, by all means, you're more than welcome to do that. I know you're the vice president over there at 367 Advisors. You have a background working for a much larger, very big, like Fortune 200 company, though, right? Where you did over 30 transactions. It was over like $150 million in business. I know here locally, you're on all kinds of different boards, most of them pertaining to the sport of golf. I did pick up on that. So I noticed a theme there. But, most importantly to me, because I am as well, you're a husband, you're a father, and you've actually got another little one on the way, right?
That's right. Yep. Next June.
So that's fantastic. Well, I will hand it over to you and I'll let you take it away from here. I'm going to bring this down. If you want to go ahead and bring up the screen to share, I will turn it over to you, my friend.
Great. Yeah. Let me, clear to share my screen here.
Absolutely.
Okay. Grab the right one.
It's always fun doing the switch over there live,
All right. Can you see it? Here we go.
It looks like it's coming. It says started screen. There we go. You're up and running, my friend.
All right, great. I'm going to kind of jump around a little bit, not necessarily in order here, but, kind of want to cover a few things. I'll start with a quick intro of myself. As Jake said, I sort of co-lead origination efforts for sell-side M&A, mostly here at 367. We have a few different services, mostly, obviously, topic of today, representing companies through the sale process, but we have some other ancillary services that, we're always trying to help business owners in any phase of their life cycle. So if there's anything outside of just, running through the process of a sale, we obviously have other services that complement that. My focus is to primarily, help educate business owners that have never been through a sale transaction. And, we help with valuation. We help with, just general education on what the process looks like if people have never been through it, right? As an origination sort of role, I bring in new business. We have, a lot of referral sources in town. Jake, obviously, one of those referral sources, and we always try to plug in the right, resources whenever it's not, something in our department, right? So sort of in my role, I manage a lot of those relationships on behalf of our firm, manage a lot of the relationships with the buyers that we're selling to, mostly private equity groups. And, as you can imagine, private equity groups have their business development folks and, they're always looking for the, deals, if you will, that we're bringing to market. So, very much beneficial to our clients. If we have really good relationships with the buyers, it's, always a good outcome there. Prior to 367, I was in commercial real estate, CBRE. A lot of parallels between real estate and mergers and acquisitions. Fortunately, I'm more on the business development side, so not as much in the actual numbers as much as my team is. Very blessed to have a great team behind me. They're sort of the brains of the operation, if you will, and I'm sort of on the front lines. I'll kind of touch on our firm here. I'm going to pop back up to the top. So, a couple things I want to cover today is, if you're unfamiliar with mergers and acquisitions in general, there's different areas of the market where different size firms play. There's business brokerage, and typically business brokers are selling to other owners, right? They're not selling to institutional buyers for the most part. And the way that they market to those companies is totally different than the way that we market to buyers. So I'm going to focus on sort of what we, cover today. And obviously, if there's any questions coming out of this, happy to answer that. Generally speaking, you've heard of a Goldman Sachs, a Raymond James, Harris Williams. These are the larger investment banks that, represent companies that are public. They represent companies that are, selling for the second or third time. Our role here is really, we provide the same sort of, advice and team as those larger banks do, but to a smaller end of the market. And where we play mostly is, companies that are profitable around $1 million of EBITDA, up to about 20 million of EBITDA. So, we sort of play in that size range. The reason being is a lot of the buyers that we market to are, institutional investors, and they have an investment thesis that, they have a minimum investment criteria. Some of them, not necessarily as much of a maximum, but, we sort of cover the low end on where they play, because there's a lot of great, founder-led companies that, will sell to an institutional investor. If you've heard the term roll-up strategy, there's a lot of smaller companies that get rolled up into a platform company. So, obviously a lot to sort of unpack there, but we can cover that later on. As far as sort of, our team and our strategy, as I mentioned, we have the same approach as a large national investment bank. I head up business development. We have a sell side team. So, specific team dedicated to every transaction, which is very critical in the sale process, because, we essentially have no gap in coverage. If you were to have, just call it a one-man band, broker, and there is a market for that, and, they serve their clients well, there could be a scenario where, they go out of town, or, they get sick. And, the process that we run, it's very time oriented. So, generally speaking, it could take between, on the low end, 6 months to sell a company. It could take a year. But throughout that timeline, we're talking to our clients on a weekly, sometimes daily basis, just depending on where we are in the process. And to sort of, keep that process on track, it's always good to have a, 4-person team to, have that support. So there's no gap in coverage, if you will. One thing that we pride ourselves on is, we're problem solvers. We're not just there to represent your company and market it, if you will. We're there to solve problems early on, make sure that we're getting ahead of any of the, sort of, things that buyers are going to try to negotiate against you. So we want to position your company in the best way possible. It's better for us to get involved early on, so we have time to solve some of these problems. And it's also better for us to get involved early on, for people like Jake, and, make introductions to people that are going to be able to, do things behind the scenes that we don't do as an M&A advisory firm. Going to pop down here.
Taylor, real quick, not to interrupt you, but I know
Please go ahead.
I know we had a few more people jump in. I just want to make sure everyone knows, utilize that chat box, utilize the Q&A box there too. Kind of every time we do these events, depending on what the topic is, we always have sort of a range of different demographics that join. So just want to encourage everybody, there's no question too small, too big, or anything like that. I want to throw this out there. Can you explain to us what EBITDA means, Taylor?
Sure. Yeah, so the acronym is earnings before interest, taxes, amortization, and depreciation. So I may have had those mixed up in my head, but it's, essentially what EBITDA is it's a metric, financial metric that buyers use to place a multiple on to value your company. So EBITDA, generally speaking, if you look at your profit and loss statement, it's a similar number to your net income. Essentially what it does is normalize your company in sort of any economy. So buyers use EBITDA to, essentially place a multiple on, and then you arrive at an enterprise value. But, EBITDA is almost always higher than net income. It's not always true, but, ultimately that's our goal.
That's the message I kind of wanted to get out, is your EBITDA is different from your net profit, because they're backing out interest, taxes, depreciation, and amortization. Right? So understanding the difference in those numbers is very important.
Right. Yeah. And part of our process is, working with an advisor. So a lot of people have the mentality that, if they get approached by a buyer and, it seems like a great, offer, if you will, then they might pursue that. A lot of times whenever they're sharing their financials with a buyer that's approached them, they're just seeing their raw financial statements. And that's what a buyer is going to use to place a multiple on and value your company. And part of what we do whenever we come in is, we obviously do a lot of financial analysis, but calculating EBITDA and not just showing your source financial statements and showing, adjusted figures to where, a buyer ultimately is going to arrive at a valuation, we want to try to drive that number up. So that's one of our goals throughout the process. Just want to touch on, just sort of who we are as a firm. We started the firm 5 years ago, and decades of experience prior to this, collectively at our firm. We have 14 professionals here in Tampa. We really pride ourselves and have started the firm on, having good morals, building a good team. The size, company that we are, it's very important that, we keep a good culture. And ultimately, that shows through, to our clients, right? So if you can see my screen here, I'm not going to go through every one of these, but some of these are just important to know because, there's a lot of people that, sort of misrepresent companies in the market, and, your representation, gets tainted over time, right? Early on, whenever people, in our business are trying to, win new business or bring on new clients, we always see and hear about conversations that people have had that are sort of misrepresenting the value of their company. So, one thing that we always like to try to do on the front end is, we have a conversation with the business owner, we do a thorough financial analysis. We ultimately, do a valuation report, which allows us to say, hey, business owner, we know through our experience and, the transactions that we've been involved in that your business is worth X, right? It's usually a range. Let's just say it's like 10 to 12 million. A lot of times, there could be another broker in the market that they say, oh, we think your company's worth 18 million. And if there's, false, selling there and, people win business in an unethical way, it happens all the time. And, ultimately you're going to get down the road and figure out that, that's not the case. So we always want to be honest. Our best referral sources are our past clients, and that's how, we'd like to keep it going. We're very transparent with our clients. It's respect, confidentiality, relationships, and all of this, ultimately leads up to success. Like I said, it's your reputation in the market. So that's how we try to keep it. Going to touch on a few of our services here. We're sell-side advisors, as I mentioned, which is, as it seems, we're representing the company through the sale process. We also do buy-side search and advisory. So most of our strategy here really, and might not be as applicable for today's conversation, is we work directly with private equity groups and help them search for companies that could be an add-on to one of their portfolio companies. An example is the facilities, services, and janitorial industry. We're probably one of the top groups in the country that covers this industry. I think we've done roughly, about 20 transactions in this space, since we started. And, it's a lot of volume on that side. So, we have a lot of reps and, cover that industry very well. But just generally speaking, we work directly with private equity groups for that service. Corporate debt advisory, I think this sort of complements, what we do very well. We have a lot of conversations with business owners on a weekly basis, daily basis, right? Not everybody is ready to sell. And part of how we can help, run leading up to a sale is through debt advisory. Almost every company leverages debt in some capacity. And if they don't, maybe it could be advantageous for them to do that, right? So, we have a thorough process on that side, very similar to sell side. Happy to answer questions about that. But essentially, we're sourcing debt on behalf of the company, competitive financing solutions. So if a company is having trouble finding, affordable debt options, we essentially go to market and source that for them through our network of lenders. Any questions on this one?
Could I, not to back up on you, but you said something right before you flipped over here that kind of caught my ear. How would somebody tell? So if we're going to sell the company and I've got two radically different valuations from brokers who want to get my business, you said one was 12 million, one was 18 million. Like what are some of the things someone could do to understand what the company's really worth? Because I'm assuming it's like real estate, right? If broker A tells you your house is worth $1 million, but it's going to sit on the market for 9 months and never sell, you're essentially tainting, that listing. I would assume it's similar to that. Is that accurate?
Yeah, I mean, there's obviously a lot of differences between the real estate side. I mean, we don't go to market with a list price whenever we're selling a company. So it's a competitive bid process. The buyer pool that we market to, is strategic companies that are in a certain industry that somebody's in. So let's just use roofing, for example. There's a lot of it's a very fragmented market. I mean, there's thousands of roofing companies throughout the country. If we have a conversation with the roofer and our firm has done a handful of roofing transactions, we know what buyers are paying. It could just be a lack of experience on the other person's part, or it could be, they've looked at the financials and don't understand certain things that are going on within their financial statements that make them think that the company is more profitable than what they're showing. Or it could be vice versa. I mean, somebody else could tell them that their company is worth 12, and we come in and say, these are the reasons why, your net income is, $1.5 million, but we did a thorough valuation analysis and actually determined that your EBITDA is 3 million. So whenever you're placing a multiple on your EBITDA, it's pretty quick math whenever, you can jump from 12 to 18 million. If it's a 5 times on 1.5 million, a 5 times on 3 million, you can obviously jump in enterprise value significantly there. So there's a lot of different variables, and part of today's conversation, it's tough to kind of go through everything thoroughly because every business owner has their own goals and objectives through a sale transaction, which is part of what I'll touch on here in just a minute. But it's a lot easier to have one-on-one conversations too, to sort of understand, here are my questions about a sale transaction. And some people have a 101, understanding of an M&A transaction. So obviously Q&A at the end here could be helpful too.
Great.
External resources, just before we kind of touch on, transaction scenario type conversation. Obviously, we're not experts in everything, and our firm is here to directly represent your company through the sale process, negotiate on your behalf. We're here to represent you, all the way from, bring you on as a client through due diligence, and ultimately closing, right? So, financial advisors are critical and part of, the sale process. You need to have, this team in place and be prepared. The sooner that you bring this team in place, there's, significant benefits to, mitigating your tax liability. That sort of goes hand in hand with what Jake does as well. Insurance, reviewing your insurance policies, making sure you're covered. Accounting, obviously overlap with Jake here too, and corporate attorneys. So you need to have this team in place. This is, all stuff that any M&A advisory firm is going to outsource. But ultimately, it's reps that you've had a lot of, depending on however many deals the company, like in our space, has done. Just having those trusted resources out there. So kind of jumping into sort of the meat of the conversation, before I kind of get into some of the bullet points here, I just mentioned that, there's a lot of different types of transaction scenarios. And a lot of times whenever a business owner hears that, or, they think about going through a sale process, they think that they might just be selling their company 100%, right? They want to just be done with it, walk away day one. And a lot of times that's not the case. Most companies that sell, there's different structure to it, right? Through, in the transaction, it could be rollover equity, which essentially is, you're taking a portion of the transaction and rolling that equity into the company that is acquiring you. So your cash at the end of the transaction would be, a little bit less depending on what percentage of rollover equity you'd be putting in the new company. There's an earnout component, which could be, essentially you would stay on board for X amount of time after the transaction, and you have certain financial metrics that the buyer is saying that they'd like to see you hit, and then you get a bonus on hitting those numbers. There could be seller financing, which is typically a less common scenario. You see that more often for transactions that would probably be lower than 5 million of enterprise value. A buyer that could potentially be utilizing a SBA loan or levering up the company whenever they're acquiring it. So there's lots of different components to a sale transaction. Happy to answer any specifics there, Jake, but if you think we could kind of skip past that, we can do that too.
Yeah, no, I think that's great. To me, what stands out is there's so many different options for the way this can play out for you. I think, correct me if I'm wrong, but what the seller's long-term plans are probably have a lot to do with how they would make that decision. Just do most people just sell, take all their money and go retire on a beach somewhere? Or I'm sure there's people who still want to be involved. They're sort of on board for the longer vision. So they may want to sell, take some chips off the table, but still maintain a role in the business and some sort of equity in the bigger entity as well, right?
Right. Yeah. And part of what we do, as a firm is we take your goals and objectives, and that's how we go to market. So whenever we're having these conversations with buyers, we tell them, look, owner, John, his goals in this transaction are to be, done working in a year. He wants to retire. And we might know from our lens that that could be difficult. So, it's our job to go out there and negotiate and say, hey, this is what he wants, and we're not going to take anything less than that. But a lot of times it's buyers trying to reduce their risk whenever there is structure to a deal. So they don't necessarily want to take on an acquisition that an owner is walking away day one. He has all the relationships. He knows where all the bodies are buried in the company, and knows how to keep it afloat, right? So it mitigates a buyer's risk if there is an owner's willing to stick around for a certain amount of time. But ultimately, it depends on the industry. It depends on what the company does for a service. It's not an uncommon scenario where an owner gets to exit the company shortly after selling it. Most of the time, buyers like to see them stick around, but it's our job to go to market and try to secure essentially what they're looking for.
That makes sense. So you guys are essentially not necessarily making that decision for them, but getting the information of what is their goal, and that actually gets packaged into the go-to-market strategy is what I think I heard, right?
Yeah, and some of that, whenever we market a company for sale, we put together a document called a confidential information memorandum, which is the acronym is CIM in our world. In real estate, it would be an offering memorandum, an OM, but in our world, it's a CIM. And in this document, I mean, sometimes they're 70 pages, sometimes they're 20 pages. It just depends on how complicated the business is. But this is a package for buyers to review. I will say, with confidence that a lot of buyers like to see a company represented through, a company like ours. It makes their job a lot easier. It speeds up the process significantly. And a lot of times, they bid higher on companies that are being represented in a process because they know that there's other, competition involved. So, I mean, it's in a business owner's mind. I mean, if they get approached by a buyer, that could seem like the best option going forward. But a lot of times people don't know what they're leaving on the table in terms of, not going through the competitive process.
Okay.
So, kind of jumping in here, Jake, why do companies sell for high multiples? Preparation is key, right? A lot of times, prepping for an exit, it makes your company stronger, right? I mean, it's not just, a lot of people have a majority of their wealth tied up in their business. And, why would you not want to have, the best run company that you could, right? So, our job is to come in and try to point out areas where, we could identify as weaknesses, areas where we know buyers are going to try to poke holes in and negotiate against you. And the more time that we have on the front end to sort of, commandeer some of these things is obviously more beneficial for the business owner.
Is there a set, sorry, not to interrupt, but is there a set
please.
time frame for that? Should somebody start preparing 6 months before, 2 years,
I mean, look, if somebody comes to us and says we want to sell in 3 months, it could be challenging and we could try to do it. The point is, I mean, 6 months should give you a decent amount of time. 8 months to a year would probably be, most ideal. We don't always need a year. I mean, sometimes businesses are run very efficiently and they have a lot of things in place. But, if you feel like in your mind that there's things that you could be doing better, give yourself more time to do that, right? And another thing, associated with the timeline is, if you say that you want to sell in a year, that might not mean that you're done with, you might not be done working in a year, right? I mean, if you have to stick around 2 to 3 years is what, all the buyers are saying in the market, you know, you got to take that into consideration because your timeline could have increased significantly, right? So kind of jumping in further here, you know, there's obviously a lot of different factors, and a lot of times, you know, business owners think that they might be able to do it themselves. But part of what we like to do on the front end is bring in professionals like Jake, you know, tax accountants, trust and estate attorneys, and ultimately ensuring that, you know, while we care about what number your business sells for, we also care about how much our clients take home. You know, it becomes a very personal experience, right? And, you know, a lot of people are emotionally tied to their company. And we want to ensure that, you know, you're mitigating your tax liability as best as you can, right? So, you know, have some examples in here, and Jake, I'm sure we can probably send this around after, but we're not tax professionals, but I just, you know, point is here, the more that you do to properly plan for, you know, your whatever liquidity event that you're going to have, bringing in somebody like Jake to, you know, ensure that you're setting everything up properly to mitigate your tax liability is very important.
And not to interrupt, but just to jump in there too, the way the deal is structured can have a huge impact on your tax liability afterwards, right, Taylor?
Absolutely. Yeah, I mean, a lot of people, you know, they might want to wrap up a transaction by the end of the year, but, you know, if you're rolling over equity into a new company, or, you know, you have an earnout component, there's different ways that, you know, sometimes an earnout could be frowned upon. You know, if you're a seller, you're like, I don't want to have to hit these financial metrics going forward. But at the same time, you know, there could be a lot more money to be made if you hit those bonuses. And then you're also not getting taxed on, you know, the full enterprise value of the transaction in that certain year, right? So you can spread that out over time.
Yeah, one of the things we routinely run into is, I don't know if you say disputes, but negotiations on the difference in value between the assets and the goodwill, especially when it's service-based businesses, similar to what our industry is. So having that stuff
Yeah.
figured out as far in advance as possible would be my recommendation.
Yep. And there's rules around, you know, getting taxed on. If you've already received an LOI, a letter of intent from a buyer, then you're not allowed to protect, you know, certain money that you've, you know, been promised, right? And obviously Jake and his team can help you guys with that too. You know, sort of understanding the rules involved in a small business and mid-sized company, you know, around valuation, right? So our job is to come in and help companies identify, you know, certain ranges that they might be able to sell. And, you know, we know the questions to ask people like Jake. Say, hey, you know, this company is set up in a C Corp and S Corp. You know, what are certain ways that we're able to, you know, mitigate our tax liability and, you know, ensure that we're getting the highest valuation. Understanding the financial and non-financial factors that drive the value of your company. You know, we come in and we look at everything, right? So we look at your contracts that you have. Do you have, you know, a lot of customer concentration? You know, are there anything that really will ultimately affect the valuation in a, you know, sort of non-financial factor, like, you know, customer concentration? You know, do you just have, you know, relationships with your clients that are not contractual, depending on the industry, right? I mean, every company is different, but you know, we come in and really evaluate everything to ultimately, you know, determine that, you know, we can help you prepare for some of these things before you go to market. Do you need to go back to some of your customers and say, hey, you know, we need to actually revise the contracts that we have to include, you know, certain metrics that protect, or certain language that protects us? You know, everything that we do, ultimately, we try to counteract a buyer's ability to negotiate against us, right? So that's our goal, and to, you know, just try to reduce that risk. And sort of my comment earlier is, you know, the preparation side. If you're doing a lot of these things, it might be difficult to have conversations with your customer base to, you know, go back and change things. But, you know, and they might say, hey, you know, we went with you because, you know, you don't have a contract in place. That, you know, that's not necessarily a best business practice for you. And, you know, if you've already done a good job for them, they might be willing to work with you and, you know, accomplishing some of these changes, right?
In that same vein, I just want to bring up one of those things. I'm not sure. I'd love to hear your feedback on if you guys actually see this or not, but owners running personal expenses through the business. then when it's time to sell, trying to explain to the potential buyers, oh, well, no, you can just back those expenses out because you won't incur them. We've personally bought 3 companies over the years, and 2 out of the 3, the previous owners were running not huge amounts, but decent amounts of BMW lease payments and car payments and other kinds of things, where that really just lends you to ask more questions, I think, in my opinion, where, okay, maybe we're not going to have that expense going forward, but if they're running these sort of things through the business and we can blatantly see it, what else are we going to find out once we really get into things and get down the road, you know?
Right. Yeah, and I would just say, to that point, that's why a lot of people should use an M&A advisor, because whenever we do our marketing materials, we're going to call out all the itemized, line items that could be associated with, the owner's lifestyle. Things that we call EBITDA adjustments. So, if they're spending $100,000 on other items that are, personal, we're obviously going to try to, say, hey, these are not, going to be recurring expenses for the new business owner.
EBITDA adjustments. I'm writing that down. I love that term.
Yep. Yeah. So, I mean, it's not uncommon, right? And a lot of businesses do that, and they should. I think there's, a lot of times that's why people could have their own company, is to pay for other things, right?
So that's
But just making sure you're doing it appropriately, right? And making sure that you're not trying to bury it and hide it in another line item. All of these things would come up in due diligence. So, trying to call those things out and be fully transparent ultimately is the goal, because a buyer's going to discover it. So better to be honest about it.
So it's not necessarily going to be a deal breaker, and being upfront about that stuff and being prepared to answer questions of how they reflect in your books is what you recommend.
Right. And another thing too, if you're looking at an owner's compensation, you have sort of a couple ways to go about it, right? But, you could be taking a higher salary through your profit and loss statement, or you could be taking a distribution from your balance sheet. If you're not paying yourself a very high salary, and a new buyer comes in and they say, hey, well, the guy that owns the company is not paying himself very much. We're going to have to hire somebody in that role and pay them a lot more. So that could be, a deduction from EBITDA, a negative adjustment to EBITDA. So, a lot of these things, obviously, if we get involved earlier on, we can sort of cover those bases and make sure that, we're going to get the highest EBITDA that we can whenever we go to market. Positioning your company properly. A lot of times, really what this could vaguely mean is, we're trying to position your company in the lens of a buyer. And, sort of the theme of today's conversation, really. But, we know what the buyers are looking for. Every industry is different. We're generalists as a firm. At the end of this year, we're going to close our 70th transaction since we started 5 years ago. So, very much, volume oriented and taking on quality clients. And throughout the 70 transactions that we've closed, we've covered, quite a few different industries. Pretty much you could name it, and we've probably touched it outside of oil and gas, or, something very niche. So, part of our job is that, and, positioning your company properly could also include having fireside chats with buyers, before you go to market. Hey, owner, we have good relationships with some of these private equity groups, and we know sort of that, they would be very competitive in the process that we run. Let's have a couple conversations with them early on. A lot of times buyers like that, even though, we might not have the true financial picture, they get a chance to meet the owner directly, because, it's very much a financial transaction, but it's also, a culture thing. I can't tell you how many times we've seen, sellers pass just because they didn't like the buyer, and also vice versa, right? So
Wow.
it's the cultural fit, and a financial picture too.
So if I could real quick, you said position your company properly. That takes me back to, you mentioned earlier, being part of a roll up. So where a more of a larger corporation is going all around the country, maybe around the world, scooping up smaller companies in their same industry. They call that a roll up, right? How would
Yes.
somebody know if that's happening in their industry? Like, Like I know that's happening in the accounting and tax space right now. The big four firms are always looking to pick up much smaller firms, the size of ours, or bigger or smaller or whatnot. But somebody in other industries, like how could they be aware if that was going to be a part of the strategy or not?
Yeah, I mean, generally speaking, a roll up is sort of a size of a company. Um, Private equity groups, they have platform companies, and that's what they roll companies up into. Other strategics, they add companies on through acquisition, through a roll up strategy. But roll up strategy is really mostly used on the private equity side whenever they have a very aggressive acquisition strategy. Um, it's a financial metric mostly. So private equity groups, they have a very sort of prescriptive investment thesis. And what that means is like they'll say, hey, for add-on opportunities, we'll look at companies that are between 900,000 of EBITDA to 4 million of EBITDA. And then they pick up and say a platform investment for us is going to be any company that's over 5 million of EBITDA. A platform really is a company that has the infrastructure built, a company that is, could easily be integrated or have a smaller company be integrated into it. And a roll up is really for like smaller companies that would become a part of a larger company. Um, you know, Obviously having a conversation with somebody in our world, you would sort of be able to uncover that quickly through having just one conversation. We could size that up. Um, but generally speaking, it's a financial metric behind a company is sort of the roll up size.
If that was the scenario, could a seller, if they wanted to, put requirements on the sale of, you have to keep X number of employees for X number of time or those sort of things? Because I would assume if a much bigger, better operational company is rolling up a smaller one, it's for economies of scale. They're going to want to run it more lean, probably let people go. Is that something you guys run into?
That's not always the case, and a lot of times, there's a sort of negative connotation associated with selling your company because they think that they're just going to clean house whenever they come in. Um, you know, a lot of times buyers actually, will pay more for companies that have a better team internally, right? They want that back office. They don't want, if you're running your company lean, that doesn't always mean that that's the best run company, right? They like to see, if somebody in a key financial role, they want to see somebody in somewhat of an HR role, you know, just the executive office infrastructure, if you will. But to your point, there are certain things that they have cost synergies with, economies of scale, like you said. I mean, that could involve insurance. You're saving a lot of money through the insurance relationship. They could they could outsource HR. They could have they could just have like your CFO report to their CFO. That doesn't necessarily mean that they're just going to get rid of your CFO. So they still need that team in place, and a lot of times it just depends on how a portfolio company of a private equity group is run. Sometimes they like them to sort of operate independently. They might want them to keep the same branding, keep their same name. Some private equity groups like to rebrand. And so with just different dynamics in both scenarios, there's different synergies and ways to save costs. It's sort of a political answer, really. I mean, it's tough to say that somebody would just come in and clean house because I mean sometimes people ultimately will fire people or let people go, but that's not why private equity groups buy a lot of these companies, because they're really a partner for the company going forward. They like for owners to stick around and stay involved in the business, and they want to have that good relationship going forward. So whenever you're selling, you're interviewing people that you're going to partner with. It's not just I'm selling out. It's somebody that you're going to trust and think that you could take your business to the next level. Kind of jumping down here to the last bullet point here. Um, this is sort of a bit redundant, but ultimately you want to take care of not just yourself in the transaction. You want to take care of your employees. And there's a lot of things on the tax side, Jake, that people like yourself can help out with to if you're setting aside a pool of equity in the transaction that's going to go to some of your key employees, what's the best way to properly plan so whenever they get bonused or gifted, they're not paying the highest amount of tax that they could get paid. and ultimately protecting the company too in that capacity. Sorry, any questions on that last one, Jake?
No, it's great. I think we're doing great here. Just a reminder, if anybody out there has any questions, put them in the chat, put them in the Q&A box. We'll answer it. I've selfishly been asking a lot of questions here. I think you're on a roll so far. I want to make sure everyone knows how to get a hold of you as well too. So if anyone has any questions or anything like that, we'll make sure to share your contact info for everyone. But I think keep going.
Great. And sorry, my computer screen's on the left here, so that's see me looking to the left. I touched on the SIM. Obviously that's the financial package or the marketing package that we go to market with. Kind of going just off script here, I thought it might be helpful to just kind of talk about what our process looks like for, whenever we start having conversations with business owners. If you've never been through a sale transaction, you might think that you could just post it online or, how do we go about, sourcing buyers for the company and what does that process look like, right? From whenever we sign on a client, I mentioned this earlier, it's typically a 6 to 8 month process, but what goes into that? Whenever we're bringing somebody on as a client, we're requesting all of their financials, all the information about the company. We're doing our own analysis to ultimately be able to put that in the SIM, the confidential information memorandum. So it's very much a hands-on experience. It's a daily conversation, could be for a month. Might not be every day. A lot of times it's just like, hey, we need this one thing. Could just be an email, but point is, we can move as quickly as we get information on the front end to build out the marketing materials. During that same timeline, we're also compiling our buyer list. So whenever we market a company, we're going directly to buyers, okay? And I mentioned, we don't have a price listed on the company or anything like that. We don't have a list price. So whenever we go out to the buyers, it's very much a competitive bid process. We go to both private equity groups and we go to strategic buyers. So if your company is a printing company, we're going to go to all the most acquisitive printing companies in the country. We're also going to go to all the private equity groups that we know are making investments. They have a roll-up strategy in that space. They're looking for a new platform. That's the buyer pool that we're going to. And, that can take, a couple weeks just to make sure that we're, uncovering every stone and not missing any buyer. Because I can't tell you how many times we've gone through a sale process where we thought we knew who the buyer was going to be just based on, they've made a lot of acquisitions in that space. And it ends up being somebody else that, we're glad we spent the time to do the extra research and they ultimately, bid it higher on the business and we're a better fit. So, we try to go to, depending on the type of, industry, it could be 100 buyers, it could be 300 buyers. We're running a process right now, we're going to 500 buyers. So it just depends on the industry that they're in, but it's a very intense process on, making sure we're doing our research on the front end. I'm going to touch quickly, once we get on to, having conversations with buyers, we request IOIs, indications of interest, which is not a formal offer, but it's, a buyer saying, hey, we're going to value the company between, 6 to 7 times. And, here's a high level overview of sort of the structure we're going to propose. That ultimately is going to lead to a letter of intent. And all of this is, date based. We say, hey, we want an IOI by this date. We want an LOI by this date. And, the LOI is really where you get to, it's a non-binding agreement, but it outlines everything a lot more thoroughly of what to expect from the structure of their offer. Have conversations with sort of the top groups that, we received LOIs from, narrow it down to a few that we think are going to be the best fit culturally and financial. And then, lead to a purchase agreement, which could be a 60 to 90 day process, bringing in counsel, making sure the buyer is going to do a quality of earnings report. There's a lot of different, factors that go into that. So all in all, sort of a 6 to 8 month timeline, very involved. We bring, 4-person team in to sort of manage that process. And the goal through this process is that business owners are not going to have to take their eye off of running the company day to day. We're going to take all that weight off you, because the last thing that we want, for you and for us is to get to, a purchase agreement and your company has declined in revenue. And then all of a sudden, the buyer is trying to renegotiate the offer. So we want to make sure that you're focused on the business. We're going to take all that weight off of your plate and make sure that, ultimately we get to, you continue growing your company as you were.
What about that raises a question for me, Taylor. What about like confidentiality? So, someone's going to sell their company. I would assume last thing you want is all the employees to find out, or your management team to find out. Are there certain steps people need to take, or is that something you help them through as well?
Yeah. Yeah. I mean, a lot of times people want to bring in one of their key employees, somebody that's going to know about it internally. A lot of times it could be, somebody that's handling the financials for them in a, CFO capacity. Because that's going to make the process a lot easier whenever they're working with us and having to request data. And they don't want to trigger any, red flags to anybody in their finance department. It's like, why is he asking for all this info? So it's always good to bring in, a key employee. Sometimes people don't though. I mean, if you outsource your accounting and, we could work directly with your accountant, you could wait until the day of close to tell your employees. It just depends on sort of, your relationship that you have with your employees and how, involved you are day to day. But earlier the better. Sometimes, you want to keep it kind of on the hush and not tell as many people, as possible. So, yeah, hope that answers that question.
Oh, absolutely.
I wanted to leave a few minutes here at the end, Jake, just for some Q&A, but happy to touch
Yeah.
on anything that, you think we missed here.
No, look at that. We've been going almost an hour. I applaud you, sir. There's a ton of great information. Anybody out there, if you do have some questions, type them in the chat or the Q&A box. We'll make sure we get those answered. If not, I've got plenty of more questions that I could always ask Taylor. I could probably pick your brain for a couple more hours here. I did put Taylor's information in the chat. How do people get a hold of you? I think that's probably going to be the number one thing is if somebody, has a question or this is something they're thinking about potentially looking at in the future, should they send you an email, shoot you a text, phone call? Like what's the best way to reach out if someone did have more questions on their personal situation?
Yeah, either way, I mean, whatever people are comfortable with. I've found that more people like texting than I have, in the past. So either way, email or text. I would say, sort of some call to action. We do a lot of these conversations up front at no cost. So, if you're just looking for, hey, what's my company worth? I don't want to go out and get a business valuation. We can size it up pretty quickly without, having to get too granular. Obviously, looking at your financial statements, that's, the main component of that. We're just, kind of understanding, what do we do next? We want to sell in a year or two. Can I have, sort of a tailored plan for me and my company on how to get there? So, we do a lot of that on the front end as in more of a sort of consulting capacity. Ultimately, we'd like to work with you through the sale process, but, we have different approaches too. You don't always have to run a formal sale process. I'm biased because I think that's, where you get the most value. If you're like, hey, I don't want to pay a retainer and a success fee, and it's in an industry where, we might know a handful of buyers that we could introduce. That's always, a scenario that we could explore together. Our goal here is really just to make sure that, you're getting the most value for your business and you're finding the right partner. So
to really be a resource. And so 367 Advisors is the name of Taylor's company. tyoner@367.com is the email address. And then we got your phone number as well. I put that information in the chat. Reach out to Taylor if you have any specific questions about your personal situation or you want to explore it a little further. We haven't had any questions come up, which I always say that means you covered everything so concise and so perfectly, Taylor, that no one else could actually have any specific questions about it. And so we'll hang out for another minute or two. I'm sure Taylor could keep talking for another few hours if we wanted to.
I'll keep going.
I love it. So we actually, I bumped in you at the office here earlier and I was doing a presentation then. It's like, man, I could do this stuff all day long. So we got just a couple minutes left for what we scheduled here. So out of respect for everyone's time, we will cut it off in just another minute or two. I'd say if anyone does have a last minute question, pop it in the chat, pop it in the Q&A box. We'll answer them. If not, Taylor, I'll let you get back to making all these big deals over there. We'll let everyone who tuned in get back to running their business and everyone can kind of go about their day. So.
Well, I appreciate you having me, Jake. hopefully there was some value to be uncovered here. I know it's covered a lot of bases here, but like I mentioned earlier, it's a lot easier to sort of uncover, specific questions by having a one-on-one conversation. So happy to have those conversations with anybody that would like to.
Absolutely. For me, the number one, I wrote down a whole bunch of stuff, but the number one thing I wrote on the top, like double underline, was preparation, which we're big fans of. Reminds me of just being proactive is better than being reactive. There's probably no time frame that's too early to get started on this stuff and reach out to somebody like Taylor to help you out with it. So
Appreciate it, Jake.
absolutely. Yeah, we'll stick around for just another minute. If nobody has any questions, we'll wrap this thing up, let everyone get back to enjoying their day. Taylor, I can't thank you enough. I really appreciate it. We'll go ahead and cut you loose. We'll see you guys next time. Thanks, everyone.
Thanks, Jake. Bye.
All right. See ya.